In our today's lesson, we are going to be looking at one method of preparing depreciation or calculating depreciation. It is called straight line method. You see, I want to say that before we make progress, I want to point out that this is not the only method that can be used in calculating depreciation. We have more than 8 different methods that can be used to calculate depreciation. Depends on the policy of the companies or business that are involved. But in today's lesson, we want to emphasize on straight line method. Our focus is just to ensure that students will not find it difficult to solve related questions on this particular method. The lesson objective is simply to define straight line method of depreciation, state the formula, solve related questions, and post provision for depreciation into the necessary account. And then at the end of the lesson, there's what we call success criteria. Things that can really show that we have achieved our objective. Number one, if we are able to define straight line method of depreciation, state the formula, solve related problems, and post provision for depreciation into the necessary account. Now let's just look at the definition of straight line method. What is straight line method of calculating depreciation? We said this method make provision for equal amount to be charged as depreciation for each year of useful life on an asset. The depreciation is ascertained by dividing the cost of the asset less the residual value by the number of estimated useful life. I want to say here emphatically that students should not forget that whenever the straight line method is adopted in calculating depreciation, an equal amount is used throughout the useful life of the asset. The word useful life here simply means that if an asset is in the company and is not contributing economically, there is no future economic value or there is no present economic value of the asset to the company, the asset is useless. So when we say useful life of the asset, we are talking about the estimated period within which the asset can contribute economic value to the asset. Let me repeat that. I said the useful life of an asset is a period within which the asset can contribute economic value to the business. So when we said equal amount, we are talking about the amount that is charged as asset will be spread all over. Like for instance, if it is 10,000 that is arrived at as the depreciation of the asset for the period, that 10,000 will be charged in year 1, in year 2, year 3, year 4, down to the end of the useful life of the asset. Now let's look at the formula. We're talking about the formula of straight line method. There is a formula that is used to calculate the straight line method of depreciation. We said you should divide the cost of the asset less the estimated or residual value by the number of useful life. Let's look at it on the board. When we talk about the form, we said you should divide. This is the cost minus estimated value all over what? The useful life of the asset. Or just write useful life. Useful life. We said the cost of the asset minus the estimated value all over what? The useful life. This estimated value can also be called, you can call it estimated, or you can call it residual, or you can call it what? Scrap. Either you call it estimated value, or you call it residual value, or you call it what? Scrap value. All of the three of them means the same thing. Estimated value means the value of the asset at within a period. The residual value is also the value of the asset at the end of the useful life. Estimated value is the value at the end of the useful life, while residual value is the same thing, and then the scrap value. So your cost minus estimated value all over the useful life is the formula that can be used to calculate depreciation using the straight line method. Another thing I want to point out is that when we talk about straight line, I have said that equal amount is charged all through the useful life of the asset. When you say something is straight, it can either be horizontal or it can either be what? Vertical. What we are saying is that if you want to plot it on a graph, the line must either be vertical line or it has to be, or it must be what? Horizontal line. But it must be a straight line. All right, let's look at an illustration to really explain what we mean by straight line method of calculating depreciation. Now, if you look up, they said a machine costs 12,800 naira. It will be used for 5 years and then be sold at a scrap value of 400 naira. You are required to, number 1, calculate the depreciation for each year. Number 2, prepare the depreciation schedule. Number 3, post the depreciation to the necessary account. Let's start with number 1. Number 1 says solution. Number 1, I say you should do what? Calculate the depreciation for each year. The depreciation for each year is simply cost minus scrap value all over what? Useful life. All over useful life. All over useful life. From the question, cost is equal to what? Cost is equals to 12,800. And then the scrap value is equals to what? 400. And then the years useful life is equals to what? 5 years. Now let me explain something. When we talk about this is the cost of acquiring the asset, and the scrap value here is the value at the end of the useful life of the asset. If we want to sell this asset, how much can we sell it after 5 years? They are saying that even if we bought the asset for 12,800, after 4 years, the cost of the asset will drop to what? 400 naira. So you must ascertain, you must try to predict. You can stay in this part in the current year and predict what the value of the asset can be in 4 years. After 5 years. So after 5 years, the cost will be what? 400. And then they said the asset will last for what? 5 years. Now, haven't itemized that. Let's put them in the formula now. The cost is what? 12,000. So you have 12,800 minus what? 400 all over 5. This will give you what? We are going to use our mathematical to 12,800 minus 400. It will give you what? 12,400. It will give you 12,400 all over 5. Now let's divide 12,400 by 5. Divide by 5. It will give you 2,480. This will give you 2,480. So this 2,480 is the depreciation for each year. Remember, we are using straight line method. So by straight line method, year 1, year 2, year 3, year 4, year 5 will be going with what? 2,480. So 2,480 is the amount of depreciation that will be charged all through the 5 years of the useful life of the asset. So you come here and say the depreciation. You say the depreciation for each year. Depreciation for each year is what? Depreciation for each year is what? 2,480. 2,480. Now let's look at number 2. They say number 2, you should do what? Prepare the depreciation what? Schedule. What we will do so that we will have space, we will just write only the answer here. The depreciation is equals to what? 2,480. All right, so that we can have space. Then the second one, they say depreciation schedule. Depreciation schedule is a tabular depreciation schedule. It is simply a tabular representation of the depreciation. When you put the depreciation in a tabular form, you have prepared what we call a schedule or a schedule. So let's quickly prepare it. It will come with 5 different columns. We have a column for the year. We have a column for the depreciation, the cost. We have a column for depreciation. We have a column for accumulated depreciation. And we have a column for what? The net book value. So let's quickly rule it. This is the year. This is the year. Y arrow. This is the depreciation. D. Depreciation. And then, okay, let's write the cost before the depreciation. This is the cost. And then this is the depreciation. And then this is the accumulated depreciation. And this is the net book value. So this is how the depreciation schedule will look like. So you have year 1, year 2, year 3, year 4, and the what? Year 5. Year 1, year 2, year 3, and then year 5. So you have 1, 2, 3, 4, 5. Please, I want to point out at this point that students should know that even if the asset will last for 10 years, the column here must be up to what? 10. But since it's going to be just 5 years, that's why we are having from 1 to 5. And then the cost of the asset cannot change. The cost of the asset will not change because the cost at which you bought the asset must always be the same. So you come here and you write the cost of the asset 12,800, 12,800, 12,800, 12,800, 12,800. That is the cost. And then the depreciation is, we have calculated it and we said it is what? 2,480. And we are saying that this is straight line method. That means that it will not change. The 2,480 will remain the same throughout the period. So you have in year 1, it's going to be what? 2,480, 2,480, 2,480, 2,480, and then 2,480. You can see now that the asset does not change, the depreciation does not change. 2,480, 2,480 down to the 5th year. And then the next one is what we call accumulated depreciation. This is where students usually find it very difficult to understand. When you talk about accumulation, accumulation has to do with the piling up of things. When something is being piled, we can say that thing is accumulated. Accumulated debt has to do with piled up of debt. Debt over time, over a period of time. So when we say accumulated depreciation, we are talking about the depreciation that has been piled up. Depreciation of year 1 is added to depreciation of year 2, added to depreciation of year 3, down to depreciation for year 5. That's what we call accumulated. So for year 1 is always the same. You have 2,480. Year 1 is always what? The same. And then for year 2, the accumulated depreciation for year 2 is depreciation of year 1 plus depreciation of the current year. Remember, the depreciation of year 1 is 2,480. And then the depreciation of year 2 is the same thing, is 2,480. So in the accumulated column, you have depreciation of year 1 plus depreciation of year 2. So you simply add depreciation of year 2 to depreciation of year 1. When you add 2,480 plus 2,480, you are going to have 4,960. You're going to have 4,960. When you add here to this place, you add this value and this value together. When you add 2,480 plus 2,480, you have 4,960. And then the depreciation for the accumulated depreciation for the 3rd year is the depreciation for the third year plus this. So you add 2480 plus 4960 plus 2480. What is the value? Is 7440. You have 7440. That's when you add 2480 to 4960. When you add the depreciation of the third year to that of 4960, you have 7440. And then you add the one for 48 to this to get this. So you add again plus 2480. You have 9920. You have 9920. 9920 is when you add here to this place. You add here to this place to get here. And then the last but not the least is for you to add another 2480 to have 12400. 12400. So you can see now, when you add here to here, you get here. Now let me come all over again. The beginning must be 240 because that's the beginning of the year. The one for second year, you add here to get here. Add here to get here. Add here to get, add here to here. 2480 to 4960 to get 7440. And then 2480 to 9920 to get 2480 to 7440 to get 9920. And then 2480 to 9920 to get 12400. Now we have filled that column. The next one is net book value. The net book value is the value of the asset at the end of each year. What is the value of the asset at the end of each year? Now, I want to point out something. Please, students should not subtract depreciation from the cost of the asset. If you subtract this from, you can see now that the depreciation doesn't change here. So if you subtract column 2, let's make it column 1, column 2, column 3, column 4, and then column what? 5. So that by the time we want to name it, we'll be able to understand. So if you subtract 3, column 3 from 2, you always get the same answer here, which is very, very wrong. Let me emphasize that. When you subtract column 3 from column 2, you will always have the same answer here. And you know that the value of the asset cannot be the same all through the period. So you cannot do that. Rather, you are going to subtract the column 4 from column 2. You subtract column 4 from column 2 to get column 5. So let's go. If you subtract 2480 from 12800, you are going to get a value. Let's go. 12800 minus 2480. You are going to get 10320. 10320. So this 10,320 naira is the value of the asset after year 1. After year 1, the value of the asset is 10,320. Let's go to year 2. What will be the value of the asset after year 2? After year 2, you subtract this value from this value. You subtract 4960 from 1280. Let's go. 1280, 12,800 minus 4960. 4960. 7840. You have 7840. 7840. And then we subtract 7440 from 12,800. 12,800 minus 7440. You have 5360. 5360. And then you subtract 9920 from 12800. 12800 minus 9920. You have 2880. 2880. And then when you subtract 12800, When you subtract 12,400 from 12,800, you have 400 here. Now, let me explain. I want to point out two things before we go to the next requirement. I want to point out the fact that when students are making this subtraction, they should not be in a hurry. It should take time because the examiner will want to know how you are able to compute your table. First of all, I have said that your net book value is the value of the asset at the end of each year. So when you subtract here from here, you get this value. Subtract here column 4 from column 2, you get this value. Subtract here from here, you get this. Subtract here from here, you get this. Subtract here from here, you also get this. But in another way round, student can also get this same value if you are always subtracting this. If you subtract here from here, you get this. Subtract here from here, you get this. Subtract here from here, you get this. And subtract here from here, you also get this. That's another way you can do. You can subtract column 3 from column 5, and then you are going to get, but that is going to give you a very long subtraction. So we will recommend that students should just maintain the subtraction of column 4 from column 2. That's the first thing I want to point out. Now, the second thing I want to point out is that at the end of the 5th year, the value you have here, this value will determine if your work is correct or not. You can see from the question they said that then it will be sold at a scrap value. That scrap value is what we call the disposable value or the estimated value or the residual value at 400. So you can see now we have arrived at the 400. This 400 is the residual value of the asset. So at this point, students, once you arrive at 400 here, you can be very sure that you have done the right thing. So this is how the depreciation schedule look like. It has 1, 2, 3, 4, 5 different columns. The first one is for year. The second one is for cost. The third one is for depreciation. The fourth one is accumulated depreciation. And the fifth one is for what? Net book value. The cost does not change. Depreciation does not change. Accumulated depreciation is simply column 1, year 1 plus year 2 will give you the first column. Year 2 plus year 3 will give you the second, down to the last column. And then for net book value, is simply your accumulated depreciation minus your cost. Column 4 minus column 2 will give you this. And then at the end of the day, you check if the value you have here is equal to the residual value that what I was given in the question. Now let's quickly look at question 3. I want to wipe the board now. Let's quickly look at question requirement 3. It said you should do what? Prepare the account. You should do what? Prepare the account. Let's quickly look at it. Now I have explained earlier that in depreciation, 4 different accounts are prepared. The 4 different accounts that are prepared, they are what? Number 1, asset account. Number 1, asset account. Number 2, profit or loss account. Number 3, provision for depreciation. For depreciation account. And then number 4 is what? The balance sheets. These are the 4 accounts that are involved. The first one is asset account. This is where you write the value. You write the asset, the value of the asset. Then profit or loss account. This is where you post the various depreciation. And then provision for depreciation account is a liability account where all the depreciations within the year will be recorded, and the balance sheet is the statement that shows the value, the net book value of the asset. So let's quickly start with the asset account. From the question, they said a machine costs this. Now, when they say a machine, they don't really point out the particular machine. So let's assume that this machine is let's take it motor vehicle. So if you want to open, you can say motor vehicle account. Motor vehicle account. So you just write motor vehicle account. You rule your line, and then here is your credit side and here is your debit side. We are using Naira. So since we are using Naira, you come down. Now, the value of the asset is the cost of the asset. So you simply come here and you debit cash here, and then you write 12,800. This is your balance carried down, 12,800, and that will be the value of the asset. Anybody that access the ledger now will see the corresponding entries in the ledger. You see that in motor vehicle, we were able to buy 12,400 naira worth of motor vehicle. We have completed that. Now, the second account that is involved is the profit or loss account. You come down and you write your profit or loss account. This profit or loss account is just the extending is an extension of trading profit or loss account. The part of the trading profit or loss account that borders or centers on expenses involved in the business. And as a matter of fact, if you can remember, you can have a picture of how it looks like. You see that at this point, it looks like this. And then on the credit side is the gross profit brought down, while you have the expenses lined up here. So the expenses lined up here, depreciation is one of those expenses. So what you need to see, just see, you see that each of the year, like in the year is not specified here. Let's assume that this depreciation was actually, this asset was acquired, maybe let's assume it was acquired in 1990. So we have 1991, 1992, 1993, 1994 and 1995. We have these various years: 1991, 1992, 1993, 1994, 1995. So you simply come here and you write your depreciation for each of those years is 2480. That's for 1990, 1991 depreciation. You have 1991, you have depreciation is 2480. 1992, you have depreciation, the same 2480. And then 1993, depreciation 2480. 1994, depreciation 2480. 1995, depreciation 2480. So this is how you prepare it. So if anybody that looked at it now, you know that 1991 depreciation is this, and because it's straight line method, the depreciation doesn't change. So each of the year comes with its unique depreciation. So as you can see the way it's represented now, this will not be added to other expenses that are incurred within the period. All right, let's quickly move forward. Let's go to the next account. The next account is provision for depreciation. Sorry, I am going to clear the board so we'll be able to have space for other two accounts: the provision for depreciation account and the statement of financial position. So we have provision for depreciation account. That's the next account to be prepared. And then we always use our T method. Always use our T method to prepare it. This is the debit side. This is the credit side. And then you have your Naira, and then you have your Naira sign. Now, I have explained earlier that provision for depreciation account is a liability account. It's a liability account. So the value you are going to have as depreciation will be credited, and then the balance carried down will be debited. Hence, let's assume that, like we have said before, we are assuming that this period, the asset was actually, we procure it, or we acquire the asset around 1990. So the first year is going to be 1991, 1992. So we have 1991, 1992, 1993, 1994, and 1995. And then the depreciation for each year is the same. It's 2480, 2480, 2480, 2480. And then 2480. So you come here and then you write 1991. What is the depreciation? Your profit or loss is what? The value is 2480. Why do I need to write profit or loss here? The profit or loss account that is written here depicts the double entry principle that states that for every debit entry, there must be a corresponding credit entry. Remember, when we were preparing profit or loss account, we have this value debited. So because we have this value debited in the profit or loss account, that is why we are having it credited in the provision for depreciation account. And then your 1991, your balance carried down is going to be what? 2,480. You have completed that. That's for 1991. Now the next year, when you go to the next year, you have 1992. That's the second year. Now the balance of this we have to be carried into the next year, which is 1992. So you have your balance brought down, which is 2480. And then 2480, your profit or loss for the year is going to be still the same value, 480. So when you add them, this is 0, add here to here is 16, it will give you 6, carry 1. This 4 plus 4 is 8, plus that 1 is 9, and 2 plus 2 is 4. So the value you are going to have here is 4960. Now, on the debit side, you are going to have your 1992, and your balance carried down is what? 4 is going to be 1992. Balance carried down is what? 4960. So this is what you are going to have. You have 4960. This is how you are going to prepare it. Ensure that this value must be on the same line with this. It must be on the same line with this 4960. That's that value. And then for 1993, you have your balance brought down is going to be this value 4960. And then you have the one for that year, profit or loss is going to be what? 2480. So let's add 4960 plus 2480. You are going to have what? 7440. You are going to have 7440. And then your 1993 balance carried down is 7440. So you have your 7440 here. You have your 7440 here. This is your 7440. And then you do it until you get to the 5th year. The 1994, you have your balance brought down, which is going to be 7440. And then your profit or loss for the period is what? 2480. You add it plus 2480. You're going to have 99. You're going to have 9920. And then you come here 1994. Your balance carried down is 9920. So you have your 9920. And then the last but not the least is 1995. And then your balance brought down is 9920. And then your profit or loss is 2480. So you have it 9920 2480. So whatever you have there, you have 9n plus 2480, you have 12400, you have 12400, and then you come here 1995, your balance carried down is 12400 and your value becomes 12400. This is how to prepare your provision for depreciation account. You can see the way it's prepared. Please, students should take time to look at the way this account is prepared. First of all, you have the one for 1991. 1991, you have to bring down the depreciation for that year, which is 2480. And then the corresponding entry is there. Remember I said why we have P or L here is because the debit entry is in the profit or loss account. And then you close the account by these two lines. Now you come to 1992. 1992 is you bring the depreciation of 1991 into 1992. That's why we have 2480 here. And then you add the depreciation for 1992 to it. When you add, this is the depreciation for 1992. When you add it to 1991, you have 4960. And then the balance carried down will be here. Now for 1993, this value that is the total of 1991 and 1992 will be brought down into 1993 to begin that year. This is the accumulated depreciation for 1993. Then when you add the one for 1993 to it, you have 7440. This 7440 is the accumulated depreciation you have for 1993. Bring it down to 1994. You add the depreciation for that year to it to get 9920. This 9,920 is the depreciation for that year. And then the last but not the least is to bring it down for 1995 and add the depreciation. When you add, you're going to get 12,400, which is not up to the cost of the asset. So the 400 that is remaining is now the residual value. The 400 that is remaining is now the residual value of the asset. Now, the very last account we are going to prepare is the balance sheet. The balance sheet is very, very simple to prepare. Now, the balance sheet is going to we are going to consider just one side of the balance sheet since we don't have other items that we are going to represent. So you simply write their balance sheet, you write balance sheet, and then you rule your line. It is assumed that we are just considering this side. Normally, it comes with a T format like this, and then you have your asset aligned here. So, but because we are only considering depreciation, we may not be able to include all other items. So what you simply need to do, just write the cost of the asset. What is the cost of the asset for 1991? 1991, the cost of the asset is what? Is 12,000. So you just write cost, write the asset. What is the cost of the asset? You write, what's the cost? 12,800. This is a Naira sign. So a Naira sign. And then what is the depreciation? For that, you write less depreciation. Depreciation is 2480. When you subtract this, when you subtract that, 12,800 minus 400 minus 2480 minus 2480, you are going to have 10,320. You have 10,320. That is the value of the asset at the end of 1991. And then you come here, 1992, you write asset 12,800, 12,800. Now this 12,800 that you are going to have here, you are going to subtract the accumulated depreciation. The accumulated depreciation is just the depreciation of that second year. That is 2,480 plus 2,480. That is what? 4,960. 2,480, 2,480. This is 0, this is 6, this is what? 9, and this is 4. So you are going to subtract 4,960. less accumulated depreciation 4960 less depreciation 4960. If you subtract this, you are going to have a value 12,800 minus 4960. You are going to have 7,840, and then you continue down. You come down again for 1993. You have your asset is 12,800. We have 12,800 less the depreciation. Now the depreciation is the accumulated depreciation for year 3, which is this value plus what? Plus 2480. So we have 4960 plus 2480. This is 0. This is 14. Carry 1. 1 plus here is 10. Plus here is 14. And then you have, this is 7. That's 7440. So it's going to be what? 7440. When you subtract 7440, we have 12,800 minus 7440. You have 5360. You have 5360. And then for 1994, you have your asset. You have 12,800 minus. Now you are going to add 2480 to this value again. We are going to add 7440 plus 2480. You have 0. This is 12. You carry 1. And then 1 plus this is 5. This is 9. And then you have 9. You have 9920. So you have less depreciation 9920. So if you subtract 12,800 minus 9920, you have 2880. You have 2880. And then the last but not the least is 1995. You have your asset. Asset is 12,800 less depreciation. Depreciation is simply 9920 plus 2480. This is 0, and then this is 10. Carry 1. This is what? 1014, and then this is 1112. You have 12,400. So you have 12,400. When you subtract this, you are going to have 400. This 400 is a residual value. So this is how to prepare your balance sheet. You see now, each of the year comes with a particular depreciation. But there is something I want to point out here before we end on this note. I want to point out that students should not find it difficult, because if you look at the procedures, it's looking very, very, it's very, very bulky. The simplest way to do this is simply to subtract your depreciation from your net book value. Like in year 1 now, in this year 1, instead of you to say you are going to be subtracting the accumulated depreciation, you can simply say 10,323 minus 2480. That will give you the value that you are expected here. And then the next one, in the next year, instead of you to say you're going to subtract this from this, simply bring this down. 7840 minus what? 2480. You will have the same value. And then the next one is this one, 5360 minus 2480. You will have the same value, and the same thing comes here. When you have here, you have 2880 minus 2480. You will have the same value. If you go through this, it's going to be easier than this. But this is what WAEC expects, that you always subtract your accumulated depreciation from the cost of the asset. Now, having said that, let's go to our exam guide to see if we'll be able to get other questions that will further explain what we have done so far. When you click on the exam guide, you see the various subjects that are there. You see accounting. Accounting is an area of interest. And then for the year, you click on the particular year of interest. And then once you have done that, the area of the topics of interest is depreciation. And then you just click on get started, and all the questions that are under this particular topic will pop up. We're going to look for a question that is bordered on straight line method. Okay, let's look at question 6. Question 6 said an organization purchased an equipment for 112,000 Ghana cedis and is expected to be used for 6 years, then sold for 16,000 Ghana cedis. And then I say, what is the annual amount of depreciation if the straight line method is used? Let's quickly take that before we end the lesson. Now, let's look at it. First of all, we have said that our depreciation formula for straight line method, is given as cost minus estimated value all over what? Useful life. So the cost here is how much? 112. We have 123 minus what? Estimated value is 16,000 all over the useful life of the asset is what? 6 years. You see now? So you have 112,000 minus 16,000, divided by 6. Let's go. If you have 123 minus 16,000, you have 96,000. You have 96,000 divided by 6. So 96,000 divided by 6 will give you 16,000. So 16,000 is a depreciation that is charged for each year. So the annual depreciation is what? 16,000. A is saying 15,000. B is saying 16. C is saying 12,800. D is saying 12,000. So the answer here is C. All right, so that is how far we can go in this, our lesson for today. We have explained what straight line method is. We have also stated the formula, and we've seen how we'll be able to post the transactions into the various accounts, and we have attempted at least a question on the exam guide. We encourage students not to limit their study on what we have done so far. You can look for different questions on straight line method. Believe that what we have done so far will serve as a guide in further studies.